Welcome to the deep dive. We cut through the noise, we do the homework, and we pull out the insights you really need.
That's right.
Today we're diving into ARCC Capital's, that's ARCC, their second quarter 2025 earnings call.
Yep.
Our goal here is just to boil down what actually matters for you, especially, how they're handling this pretty tight credit market we're seeing.
Exactly. And this call, it's happening with, quite tight credit conditions all around. So we'll unpack how ARCC, as a business development company or BDC.
Right. They invest in those private middle market companies.
Precisely. How they're navigating it. And the market's initial reaction was interesting. A bit cautious, you could say.
Okay, so let's jump right in. The snapshot, the numbers first. For Q2 2025, ARCC reported GAAP EPS of $0.52.
And GAAP, generally accepted accounting principles, the standard stuff.
Right. And what's notable is that was flat compared to Q2 last year.
Mm-hmm. And then their non-GAAP or core EPS, that's the one that strips out some of the, let's say, one-off items for a clearer operational view that came in at $0.50.
Okay. And that was just a touch under the consensus rate, which was 51 cents.
Just a bit shy, yeah. Revenue landed at $745 million. Also a slight miss against the $748.8 million expected. It showed a small dip year over year, too.
So, okay, slight misses there. And right after the release, the stock, it took a little dip.
Yeah, traded down about 3% during the day.
Mm-hmm.
It suggests, investors were maybe being a bit careful, despite the headline numbers looking pretty stable overall.
But like always, the real story is usually deeper than just those first numbers.
Absolutely.
So let's get into that. Beyond those slight misses, what did the underlying financials really show about their strength this quarter? What else was going on?
Well, what's really interesting is while the top line missed slightly, ARCC actually posted some significant net realized gains on their investments.
Okay.
We're talking $170 million just in Q2. And that's important because it shows they're successfully selling investments for a profit.
Right. Proves out their investment choices over time.
Exactly. It adds to their nearly $900 million in cumulative net realized gains since they started. That's a pretty strong track record.
Mm.
They did flag $44 million in capital gains taxes tied to that, which that's a new separate disclosure. Adds a bit of transparency there. And
the value of their whole investment portfolio, did that grow?
It did. The fair value grew 3% just in the quarter, reaching $27.9 billion. That's a substantial base of assets.
Definitely. And the net asset value, the NAV per share,
also ticked up slightly, hit $19.90. And NAV per share, for you, that's basically the company's book value per share.
Mm.
Seeing that consistently grow since their IPO, it suggests real fundamental value building up.
Okay, so value's growing. What about their debt? How leveraged are they?
Good question. Their debt to equity ratio was 0.98x, pretty much the same as last quarter. And critically, it's still at the low end of their target range.
So they're being careful with borrowing.
Very disciplined, not stretching themselves, which is, a smart move in this kind of tighter credit environment. It gives them strength.
That disciplined approach, it sounds like it connects right into their liquidity and how they manage their capital. What were the big moves there?
Oh, this is where they made some really notable strategic moves. They boosted their main revolving credit line by a huge $880 million in Q2.
Wow.
Bringing the total to $5.4 billion.
Right.
And then, after the quarter ended, they added another $100 million. So since Q1, they've expanded that facility by almost $1 billion.
That's a lot of firepower. Is it just about size or the terms, too?
The terms are key here. They actually managed to reduce the drawn spread on that main facility.
Okay, meaning cheaper borrowing costs for them.
By more than 20 basis points, yeah. So cheaper capital when they draw on it. Plus, they issued $750 million in new 5-year notes at 5.5%.
And was that a big deal for them?
It marked the tightest spread for a BDC 5-year new issue since the start of Q2. So yeah, the market seems to have strong confidence in them, letting them lock in relatively lower long-term financing costs.
So putting all that together, what does their total liquidity look like now?
It's sitting at roughly $6.5 billion. And crucially, they have zero debt coming due for the rest of 2025.
Okay, so massive flexibility. How does management see that playing out?
They see this lower leverage and all this available cash, this dry powder, as a major advantage for navigating whatever volatility comes next.
Yeah.
It means they can jump on opportunities if the market gets choppy or others have to pull back.
Makes sense. So with all that liquidity ready to go, what did their actual investment activity look like in Q2? Were they busy?
They were definitely active. Gross new investment commitments were over $2.5 billion.
Okay.
And here's a telling detail. 74% of those deals were with companies they already had relationships with.
Leaning on their existing network.
Exactly. Management highlighted that as proof of their value. It lets them gain market share and get better terms, even if overall M&A is maybe a bit slower. They trust these partners.
And what kinds of investments are they making? Still that shift towards safer assets.
Yeah, definitely continuing that strategic shift. First-lien senior secured loans now make up 59% of the portfolio.
And for you listening, first-lien means they're first in line to get paid back if something goes wrong. It's a more defensive position.
Precisely. It's about protecting the principal investment. It lowers the risk profile, which is prudent right now.
And they did a huge deal too, right? Something about Dun & Bradstreet?
Oh, yeah. They flexed their muscles there.
Yeah.
They were the lead left arranger for the biggest private credit LBO ever recorded the deal to take Dun & Bradstreet private.
Lead left arranger basically means they ran the financing show for that massive buyout.
That's it. Shows their scale and clout in the private credit world. They can handle the really big, complex deals.
Okay, so active, defensive, capable of big deals. How are the actual companies in their portfolio doing? Are they healthy?
Generally, yes. The portfolio looks pretty healthy. The weighted average organic EBITDA growth.
So the core profit growth of the companies they've invested in.
Right. That actually accelerated a bit to 13% over the last 12 months. That's up slightly from 12% last quarter.
That's solid growth.
And the leverage levels at these borrowers, below the 5-year average. So these companies aren't overly burdened with debt. Average loan to value also remains low.
Good signs. And they mentioned focusing on certain types of businesses.
Yeah, focus on domestic service businesses.
Yeah.
The idea there is these tend to have less risk from things like, say, international trade policy or tariffs.
Okay, sounds positive overall. But we did see a small increase in non-accruals this quarter, didn't we?
We did. It's something to watch.
And just to remind everyone, non-accruals are loans where the lender, ARCC in this case, stops counting the interest income because they're worried the borrower might not pay it back. It's a potential warning sign.
Exactly. And the numbers ticked up modestly from 1.5% to 2.0% measured by cost.
And on a fair value basis?
From 0.9% up to 1.2%. So still relatively low levels overall, but an increase nonetheless.
What did management say about that? Are they concerned?
Their take was that these increases are driven by idiosyncratic factors, meaning problems specific to just a couple individual companies, not a sign of some wider rot spreading to the portfolio.
Company-specific issues, not systemic ones.
That's the message.
Yeah.
They really emphasize that these levels are still well below their own historical averages, especially thinking back to the financial crisis, and also significantly lower than the average for other BDCs right now.
Okay.
They expressed, pretty high confidence in their team's ability to manage these specific situations. They've got experience dealing with workouts.
Right. And look, that's what management would say, naturally. But for us, for you listening, what would be the signs that maybe it isn't just idiosyncratic? What should we watch for?
That's a really good critical question. While you take management's confidence on board, you'd want to watch if this trend, say, accelerates significantly next quarter.
Right.
Or, crucially, if the types of companies having trouble start to cluster in particular industries. If suddenly you saw issues pop up across several, retail or manufacturing names, that might suggest broader economic pressure is playing a role, not just company-specific missteps.
So look for acceleration or concentration.
Exactly. For now, ARCC's levels are low historically, but yeah, keep an eye on the rate of change and where the problems are popping up.
Got it. So switching to the outlook, what are they expecting for the rest of 2025?
They expect investment activity to sort of normalize in the second half of the year.
Which sounds positive.
Yeah, it's just a pickup. They noted that June was actually a very busy month, accounting for almost half of Q2's deal activity, kind of late quarter surge.
Okay.
And their deal pipeline, their backlog, stood at a pretty healthy $2.6 billion as of late July. So good visibility on potential future deals.
And the dividend, always key for BDC investors.
Rock solid. They maintained the Q3 dividend at $0.48 per share.
And that continues a long streak, doesn't it?
It does. Marks their 16th consecutive year of keeping the regular dividend stable or increasing it. That's a strong signal of reliability.
16 years is impressive.
And supporting that, the CFO mentioned their estimated taxable income spillover.
Ah, yes, the undistributed income cushion.
Exactly. It's estimated at $878 million for 2025, which works out to about $7.29 per share. That's a huge safety net they can use to cover future dividends if needed. Gives them real long-term stability there.
So the dividend looks very secure.
They seem quite comfortable with it and optimistic they'll add even more to that spillover this year.
What about those tariffs we mentioned? Still a concern?
Less so this quarter, it seems. They said the companies in their portfolio considered high risk because of tariff exposure now make up only a low single-digit percentage.
Down from mid-single digits before?
Right. It sounds like their portfolio companies are adapting, maybe through price increases or even exploring options to shift manufacturing locations. Show some resilience there.
Okay. And they don't have much exposure to things like steel, where new tariffs hit recently.
Correct. They noted very little exposure there, which helps insulate them further.
All right, so let's try to wrap this all together. What does this whole deep dive mean for you, the investor, thinking about ARCC?
Well, you had that initial market reaction, right? The slight dip after the earnings, the kind of neutral to cautious vibe, even a Zach's downgrade.
Because the market focused on the small misses and that uptick in non-accruals.
Exactly. But then you have other analysts like TipRanks sticking with an outperformer buy rating, pointing to the valuation and that strong dividend.
So a real split in perspective.
It highlights that tension, yeah. Management is emphasizing resilience, their amazing liquidity, the strong pipeline for H2, while the market, at least initially, maybe zeroed in on the negatives.
And how has the stock actually performed recently relative to the market?
Well, over the last month, it was up about 2.7%, while the S&P 500, SPY, was up 3.3%. Over 3 months, ARCC is up 8.3%, but SPY is up over 15%.
So positive returns, but lagging the broader market's really strong run lately.
Right. But ARCC's whole strategy now seems to be about being this really disciplined, credit-focused BDC. Prioritizing liquidity, careful investment selection, portfolio stability.
Positioning themselves to maybe take advantage if things get messy elsewhere in the middle market.
That seems to be the plan. And that consistent dividend yield, around 8.5%, that remains a huge draw, especially with that massive spillover backing it up.
So looking ahead, what are the key things to watch?
Definitely watch that dividend consistency.
Yeah.
Keep an eye on the NAV updates. And crucially, track that credit performance. Do non-accruals stay contained? And do they actually close the deals in that big pipeline?
They also hinted at growing other parts of the business, like their off-balance sheet stuff.
Yeah, vehicles like Ivy Hill. That could be another interesting growth path for them longer term.
Okay. It is time now for our This Is Not Financial Advice segment, the part where we toss out an outrageous but maybe plausible trade idea based on everything we've just discussed.
All right, so you've got this situation. The market's reaction was kind of, yeah, to the slight misses, right?
Yeah.
But management sounds super confident about their financial strength, all that liquidity, and a strong second half pipeline.
So the trade idea.
Okay, again, not financial advice, just a thought experiment. How about considering a longer term, maybe slightly out of the money call option on ARCC?
Okay, long-term call option, expiration maybe early 2026.
Something like that. The thinking is, it could capitalize if management is right about investment activity picking up in H2, and if they're right that those non-accruals really are just isolated issues.
If those things happen, the stock could get re-rated higher.
Potentially. And that huge taxable income spillover, the dividend cushion we talked about, that acts like a pretty compelling soft floor under the stock for a longer-term bullish view.
Makes it feel less like a pure gamble.
And more like a patient bet, a bet on a defensive company with strong income potential that maybe the market's overlooking a bit right now because of those small Q2 misses.
Interesting angle. Okay, let's recap the key takeaways then.
Sure. Ares Capital, ARCC, they got through Q2 2025 with pretty stable core earnings.
Despite those slight headline misses on revenue and EPS.
Right. And behind that was a really robust balance sheet. They've pivoted strategically towards safer, secured investments and built up massive liquidity.
Showing a lot of discipline in what's still a tricky credit environment.
Exactly. The market reacted cautiously at first.
Focusing on the misses and the non-accrual uptick.
But management's projecting confidence. Confidence in their portfolio's health, the dividend stability thanks to that huge spillover, and a strong pipeline that suggests a busier second half. They're ready to use that dry powder.
Okay, and just a standard reminder. This deep dive, it's purely for informational purposes. It is absolutely not financial advice. Please always do your own homework.
Definitely. And as you think about ARCC's position, maybe mull this over. Could that massive taxable income spillover, combined with their very disciplined defensive investment approach, make ARCC a uniquely resilient choice in the private credit space?
Especially if the broader economy faces more headwinds.
Do they stand out as a safer haven, perhaps? Something to think about.
We definitely encourage you to keep digging and exploring on your own. Thanks so much for joining us for this deep dive into Ares Capital's Q2 earnings call.